Today, the US dollar index, the DXY, fell below 100. Gold surged 200% to $4,340. Treasury yields retreated. The dollar weakened against nearly every major currency simultaneously, and financial media described it as a risk-on session driven by falling rate hike expectations after the weak jobs report. That explanation is accurate as far as it goes, but it doesn't go far enough. Because the dollar index at 100 is not just a round number, it is not just a technical level that traders watch. It is a threshold, a specific historically documented marker that in every previous instance during a period of genuine monetary stress has separated two very different phases of the dollar's structural trajectory. Above 100, the dollar is holding. Concerns about its purchasing power trajectory are present but contained. The reserve currency system is stressed but intact. Below 100, the currency phase of the transition is beginning. The mechanisms that this series has documented for 23 videos, the bond market stress, the fiscal trajectory, the de-dollarization, the petrodollar vulnerability, the institutional confidence erosion are starting to express themselves not just in gold prices and treasury yields, but in the dollar itself. Today, the dollar went below 100. History knows what that means, and this video tells that history. Before examining the historical significance of the 100 level, it is essential to understand precisely what the dollar index measures, because much of the confusion about its significance comes from a misunderstanding of what the number actually represents. The US dollar index, formerly known as the DXY, measures the value of the US dollar against a basket of 6 major currencies. The euro, which represents the largest weight at approximately 57.6%, the Japanese yen at 13.6%, the British pound at 11.9%, the Canadian dollar at 9.1%, the Swedish krona at 4.2%, and the Swiss franc at 3.6%. The index was created in 1973, the same year the Bretton Woods system formally ended and the era of floating exchange rates began with the base value of HIND. This means that a DXY reading of HIND today represents exactly the same value against the basket as the dollar had in 1973. A reading above 100 means the dollar is stronger against this basket than it was in 1973. A reading below 100 means it is weaker. This historical anchoring, the 1973 baseline, makes the 100 level structurally significant in a way that most round numbers are not. The DXY at 100 is not an arbitrary technical level that traders decided mattered. It is the exact level that represents the dollar's purchasing power against major currencies at the moment the post-Bretton Woods fiat dollar era began. Breaking below 100 is, in a very specific historical sense, breaking below the baseline of the era that began when Nixon closed the gold window. The DXY has three other significant limitations that contextualize its current reading. First, it is heavily weighted toward the euro and other developed market currencies and does not include the Chinese yuan, the Indian rupee, or the currencies of other major emerging economies that have been at the center of the de-dollarization trend documented in this series. A dollar that weakens against the euro while strengthening against the yuan would show a weaker DXY even if its overall global reserve currency position was strengthening against developing market currencies. Second, the DXY measures relative currency value, the dollar against other currencies, rather than absolute purchasing power. A dollar that weakens against the euro tells you that the euro has strengthened more or weakened less than the dollar. It does not directly tell you about the dollar's purchasing power against goods and services. Third, the DXY's construction means it can fall below 100 during periods when the dollar is simply less attractive than other developed market currencies, rather than during periods of structural dollar weakness specifically. The DXY's history since its creation in 1973 provides a specific and instructive record of what has followed previous breaks below the 100 level during periods of genuine monetary and economic stress. The first major break below 100 came in the mid to late 1970s, the period of dollar weakness that accompanied the stagflation decade, the oil shocks, and the Burns Fed's monetary accommodation documented throughout this series. The DXY fell from its 1973 baseline of 100 to approximately 150, losing 160% of its value against the major currency basket. This decline corresponded precisely to the worst inflation decade in modern American history, the period during which the dollar's domestic purchasing power was being systematically eroded by the monetary mismanagement that Volcker's 1979 intervention eventually corrected. The DXY's recovery from its 1980 low was dramatic and structural. Volcker's extreme tightening, the 20% federal funds rate, the deliberate recession, the broken inflation expectations drove the dollar to extraordinary strength. By February 1955, the DXY had reached approximately 164, its all-time high. The dollar had doubled in value against the major currency basket in 5 years. This was the most powerful dollar bull market in the index's history, driven by the most credible inflation fighting the Federal Reserve had ever demonstrated. The Plaza Accord of September 1955, the coordinated international intervention to weaken the dollar, driven by the manufacturing competitiveness crisis that dollar strength had created, reversed to the 1955 peak. The DXY fell from 164 to approximately 85 by 1988. The break below 100 in this declining phase corresponded to the global economic rebalancing that the Plaza Accord had been designed to produce. The second structurally significant break below 100 came in the mid-1990s when the dollar weakened against the yen and the Deutsche Mark amid the early stages of European monetary integration and the Asian economic miracle that was drawing capital toward emerging markets. This break was less structurally alarming than the 1970s episode. It occurred against a backdrop of relatively sound American fiscal management and the beginning of the technology-driven productivity boom that sustained the dollar through the late 1990s. Boom reaching approximately 130 by early 2001 as U.S. technology sector investment attracted global capital into dollar-denominated assets. The subsequent break below 100, which began in 2003 and accelerated through 2004 and 2005 as the Iraq War's fiscal costs became apparent and the housing bubble's vulnerabilities began to emerge, represented the first significant structural dollar weakness of the post-9/11 era. The most recent sustained break below 100 came in 2005 when the COVID fiscal and monetary expansion, the $3 trillion in Federal Reserve asset purchases, the multi-trillion dollar fiscal stimulus packages drove the dollar below 100 for the first time since 2015. Gold's response was immediate. It crossed $2,000 for the first time in August 2015. The DXY recovered above 100 in 2015 as the Fed's tightening cycle attracted capital back into dollar-denominated assets, reaching approximately 114 in September 2015, its highest level since the early 2000s. Today, the relationship between the dollar index and the gold price is one of the most consistent and most historically documented relationships in financial markets. Understanding it precisely is essential to reading what today's simultaneous DXY break below 100 and gold surge to $4,340 actually means. The mechanical relationship is straightforward. Gold is priced in dollars, so a weaker dollar makes gold cheaper for buyers using other currencies, increasing demand and pushing the dollar price of gold higher. A stronger dollar makes gold more expensive for non-dollar buyers, reducing demand and pushing the price lower. This mechanical relationship produces the consistent negative correlation between the DXY and gold that markets observe in day-to-day price movements. But the deeper relationship, the one that matters for the structural analysis this series has been building, is not mechanical. It is about what both the DXY and the gold price are simultaneously measuring: the credibility of the dollar as a long-term store of value. In periods when the dollar's credibility is high, when markets believe the Federal Reserve will maintain price stability, when the fiscal trajectory is sustainable, when the geopolitical architecture supporting dollar demand is intact, the DXY is strong and gold is relatively subdued. Investors choose dollar assets over gold because the dollar is both liquid and reliable, while gold is liquid but generates no yield. In periods when the dollar's credibility is low, when inflation erodes its purchasing power, when fiscal trajectories raise questions about its long-term value, when geopolitical developments threaten the architecture supporting its reserve currency status, the DXY weakens and gold surges. Investors move from dollar assets to gold, not because gold has improved, but because the dollar's reliability as a store of value has deteriorated relative to the alternative. The current combination, DXY below 100 and gold at 4,336, is the clearest expression yet in the current cycle of this deeper relationship. The DXY's break below 100 is not just a technical move. It is the currency market's confirmation of what the gold market has been pricing for months, that the dollar's credibility trajectory is deteriorating, not improving, despite the tightening cycle that was supposed to restore it. The most analytically puzzling aspect of today's dollar weakness is that it is occurring while the Federal Reserve's policy rate remains at its highest level in years. In conventional monetary theory, high interest rates attract capital into dollar-denominated assets, strengthening the currency. The 2020 dollar strength when the DXY reached 1014 confirmed this relationship. The Fed's aggressive tightening attracted global capital into dollar assets and drove the dollar to a two-decade high. Today, with the Fed funds rate unchanged and still elevated, the dollar is breaking below 100. Something has changed in the relationship between US interest rates and dollar strength. Understanding what has changed is the key to reading today's price action correctly. The change is the market's assessment of the future path of rates and what that path implies about the dollar's real return. The weak July jobs report, which showed unexpected job losses and a further downward revision to prior months, is being read by markets as evidence that the Fed's tightening cycle has over-tightened relative to the actual state of the labor market. With the QCEW-based employment picture showing a labor market significantly weaker than official payroll figures had suggested, and with today's jobs data confirming the weakness, markets are pricing a scenario in which the Fed will be forced to cut rates potentially more aggressively than previously anticipated as the labor market deterioration accelerates. A Fed that is expected to cut rates is a dollar negative signal. Capital that had flowed into dollar assets to capture the high yield of the tightening cycle begins to flow out in anticipation of lower future yields. The dollar weakens not because current rates are low, but because expected future rates are declining. This dynamic, dollar weakness driven by expected future rate cuts rather than by current low rates, is precisely the dynamic that characterized the 2020 dollar weakness. The Fed's emergency rate cuts to zero in March 2020 were priced into the dollar before they occurred as markets anticipated the policy direction. The DXY's break below 100 then corresponded to the market pricing, the full scale of the Fed's eventual response. Today's break below 100 is the market pricing, the possibility that the Fed's tightening cycle is over, that the next move is down rather than up, at a moment when inflation is still above 4%. This is the stagflation configuration that the 15th video documented, a central bank that is being forced to choose between the inflation mandate and the employment mandate, with the currency market pricing, the market's assessment of which mandate will ultimately prevail. Every previous DXY break below 100 in the post-1970 era occurred against the backdrop of an intact petrodollar system. The mechanism documented in the third video of this series, oil priced in dollars, oil revenues recycled into Treasury bonds, structural global dollar demand created by the energy security architecture, was functioning throughout the 1970s weakness, the 1980s Plaza Accord weakness, the 1990s weakness, the 2000s weakness, and the 2020 weakness. Today's break below 100 is the first one that occurs while the petrodollar system is simultaneously under the structural pressure documented throughout this series. The Hormuz conflict has demonstrated the military vulnerability of the system's geographic choke point. Saudi Arabia's BRICS membership has created institutional framework for alternatives. Yuan oil settlement arrangements are multiplying. The 2020 Russian asset freeze has incentivized every major oil producer to assess the risk of dollar-denominated reserve concentration. This structural difference matters because the petrodollar system has historically been a floor under dollar demand, a source of automatic structural dollar buying that has prevented dollar weakness from becoming self-reinforcing during previous episodes of DXY, weakness below 100. Even during the worst of the 1970s weakness, OPEC's dollar-denominated oil pricing meant that global oil demand was continuously creating dollar demand, limiting how far and how fast dollar weakness could extend. If the petrodollar floor is simultaneously weakening, if the structural dollar demand that the energy system creates is declining even as the Fed's tightening cycle ends and US rate differentials narrow, today's break below 100 could prove more durable than previous episodes of comparable DXY weakness. This is the structural risk that the gold market is pricing at 4,342 on. Gold is not primarily reacting to the DXY's break below 100 today. Gold has been pricing the structural deterioration of the petrodollar floor, the de-dollarization trend, and the fiscal trajectory for months. Today's DXY break is the currency market catching up to what the gold market has been signaling since gold crossed $4,000. The DXY's break below 100 is primarily expressed in the dollar-euro relationship given the euro's 57.6% weight in the index. Understanding what is driving euro strength and what it implies about the broader monetary system adds important context to the dollar weakness signal. The euro strength against the dollar today is being driven by several converging factors. The European Central Bank has maintained a more restrictive monetary stance than markets had expected, with Eurozone inflation proving more persistent than the ECB's projections had suggested. European defense spending accelerating in response to the NATO burden-shifting dynamics documented in the 13th video is creating fiscal stimulus that is supporting European economic activity even as the energy shock from the Hormuz conflict weighs on energy importing economies. But the most structurally significant driver of euro strength against the dollar is the dollarization dynamic from an unexpected direction. European institutions and sovereign wealth funds that have been reducing their dollar exposure are in many cases increasing their euro exposure as the nearest large-scale alternative reserve currency. This is not a vote of confidence in the euro's structural fundamentals. The eurozone's own fiscal challenges are well documented. It is a portfolio diversification decision driven by the Russian asset freeze precedent. The yen dimension is more complex. Japan's 13.6% weight in the DXY means that yen movement significantly influenced the index. The Bank of Japan's ongoing normalization from its ultra-accommodative policy stance. The process of raising rates from negative or near zero levels towards something approaching neutral has been strengthening the yen. A stronger yen contributes directly to a weaker DXY, but the yen strengthening simultaneously unwinds the carry trade documented in the first video of this series, the arrangement by which Japanese institutional investors borrowed in yen to buy dollar assets, creating structural dollar demand. As the yen strengthens and the carry trade unwinds, the structural dollar buy-in that the carry trade created reverses, adding another dimension of dollar selling pressure at precisely the moment when the Fed's expected rate cuts are over. The historical record of DXY behavior after significant breaks below 100 during periods of genuine monetary stress, specifically the 1970s episode and the 2020 episode, produces a specific set of observations about what the current break implies for the trajectory ahead. The 1970s template shows the most severe outcome. The dollar's initial break below 100 in the mid-1970s was followed by years of continued weakness, reaching its nadir of approximately 84 in 1918. The recovery only came after the most aggressive Federal Reserve tightening in its history. The assets that performed best during the dollar's 1970s weakness, gold, energy, real assets denominated in appreciating currencies, are precisely the assets that the historical analysis throughout this series has identified as the structural hedges for the current environment. The 2020 template shows a more moderate outcome. The dollar's break below 100 in 2020 was followed by a recovery as the Fed's extraordinary accommodation was replaced by the most aggressive tightening cycle since Volcker. The tightening cycle restored sufficient dollar strength to push the DXY back above 100 and eventually to 114 in 2020. The 2020 episode demonstrates that dollar breaks below 100 are not necessarily permanent, that credible policy responses can reverse them. The critical question for the current break is which template applies. The 1970s sustained weakness that required extreme tightening to reverse, or the 2020 temporary weakness that was reversed by subsequent tightening. The answer depends on the same variable that has run through this entire series: whether the Federal Reserve will implement the policy response that the structural conditions require, or whether it will find reasons to remain accommodative in the face of the labor market deterioration that the weak jobs data is revealing. If Wash Fed follows the Volcker template, aggressive tightening that accepts the pain of recession to break the inflationary dynamic and restore dollar credibility, the 2020 template may apply, and the current DXY break below 100 may prove temporary. If Wash Fed follows the Burns template, continued accommodation of the labor market deterioration at the cost of today's DXY break below 100, understood in the structural context this series has built, produces specific implications for wealth preservation that are more urgent and more actionable than the individual data points that have preceded it. The gold response, surging to 4,303,000 simultaneously with the dollar's break below 100, is the clearest confirmation yet that the monetary hedge thesis this series has documented across 23 videos is operating as the historical record predicted. Gold at 4,340 all on a day when the dollar breaks below 100 is not a speculative move. It is the monetary market pricing, the structural dynamics that this channel has been analyzing since its first video. For holders of dollar-denominated savings, cash accounts, money market funds, dollar-denominated bonds, today's DXY break below 100 is a direct reduction in the international purchasing power of those savings. Not dramatic, not catastrophic, a 0.39% decline in the dollar index on a single day does not constitute a crisis. But as part of the structural trajectory documented across this series, it is a continuation of the direction that every structural mechanism has been pointing toward. The specific wealth preservation implications follow directly from the historical templates. In the 1970s template, the scenario where dollar weakness proves sustained and structural, the assets that preserve purchasing power are gold, energy, real assets in appreciating currency zones, and geographic diversification away from dollar concentration. These are the same assets that the 8th video documented as the historical records, endorsed preservation vehicles across reserve currency transitions. In the 2020 template, where dollar weakness proves temporary and reversible through policy response, the optimal positioning is more nuanced, maintaining exposure to dollar assets while hedging the downside risk through gold and geographic diversification rather than abandoning dollar assets entirely. The honest assessment is that distinguishing between these templates in real time is the hardest analytical challenge the current environment presents. The structural mechanisms this series has documented point toward the 1970s template as the more likely outcome if policy does not respond adequately. The historical record on the difficulty of achieving adequate policy response in the current political and fiscal environment, with a Congress that cannot achieve fiscal consolidation, a Fed chair whose dot plot abstention suggests Burns template instincts, and a geopolitical architecture that is under simultaneous pressure. Today, the dollar fell below 100. Gold surged to $4.323. Treasury yields retreated as markets priced the end of the Fed's tightening cycle. Financial media called it a risk-on session, a technical move, a reaction to weak jobs data. History calls it something more specific. It calls it the currency phase of a structural transition that this series has been documenting from every angle for 23 videos. Not a crisis, not a collapse, a threshold. The same threshold that separated the pre-Volcker dollar from the Volcker dollar, the same threshold that the 2020 COVID response broke, and that the 2032 tightening cycle restored. The question is whether today's break is the 2020 version, a temporary technical move that a credible policy response will reverse, or the 1970s version, the beginning of a sustained currency phase that requires its own Volcker to correct. The bond market at 5.2%, the gold at $4,342, the QCEW employment data, the Fed shares dot plot silence, the petrodollar structural pressure, all of the mechanisms this series has documented are now expressing themselves simultaneously in the same number, dxy below 100. This is what the structural